In economic news this week, we saw the 3-month Treasury bill rates fall by 138 basis points to 11.97%, while the 12-month Treasury bill rates fell by 78 basis points to 12%. As expected during the last few weeks, we have seen the short-term rates falling faster than the long-term rates, and this is owing to the government reducing its borrowing requirement in terms of the shorter-term funds, with the increasing tax collections coming into play. However, from a borrowing cost perspective, the average weighted prime lending rate increased by 47 basis points to 12.25%, which is an uptick that we've seen compared to the previous 4 weeks where there's been continuous reduction in terms of the borrowing rates. Going into the next couple of weeks, we feel that the short-term interest rates or Treasury bill rates could even fall further. From a currency perspective, the currency appreciated further during the week, where the currency appreciated from 320 rupees to the dollar to 317 rupees to the dollar, and the improvement in the currency was as a result of improved tourism collections, reduced import of fuel bill with increased rainfall, lower demand for overall imports as a result of consumer slowdown with the increase in terms of VAT, and also the banks reducing the dollar purchases for their net open positions, which happened during the month of December. Going into the next few months, we feel that the currency appreciation will be temporary, and once import demand kicks in with economic recovery coming into play, we expect by the second quarter for the currency to start depreciating. Also, from a fiscal perspective, the government made a primary surplus of 330 billion rupees by the end of November, which is a substantial increase compared to the previous years. And also, going into the month of December, we feel with the capex spending coming into play, the primary surplus will reduce towards the 50 billion rupee mark.